Is the stock we're looking at today a brilliant, undervalued AI play flashing a strong buy, or is it just a massive value trap sliding down a devastating year-long 99% falling trend?
Yeah, that is literally the ultimate puzzle for anyone watching the markets right now. I mean, you look at the traditional fundamental screeners and the alarms are just blaring to sell and get out.
Right.
But then you look at the underlying digital treasury and it suddenly looks like, the speculative opportunity of the decade.
Welcome to this deep dive into Eightco Holdings Inc. You're going to see them trading on the boards under the ticker symbol ORBS. And our mission today is to unpack this massive stack of conflicting data for you.
Yeah, there's a lot to get through.
Because we're looking at wild price swings, completely mixed technical signals, and frankly, one of the most bizarre balance sheets you will ever encounter in the public markets. We're going to figure out exactly what is going on with this stock. But before we jump into the numbers, a quick bit of housekeeping for you listening. Please take a second to like this video, subscribe to our YouTube channel, and this is compulsory. We really want to hear from you. Leave a comment below with your feedback.
We read all of them.
We really do. Let us know what you think about the debate we're having today. Also, a very important reminder, what we are doing here is an intellectual debate and a deep dive into the provided data.
Right.
We are just exploring market mechanics. This is absolutely not financial advice.
No, definitely not. We're dissecting the how and why behind the numbers, The market is currently experiencing this profound tug of war regarding how to value legacy businesses that are transitioning into digital asset spaces.
Exactly.
And you always have to do your own research before stepping into that kind of volatility.
Okay, let's unpack this. To really understand the chaotic price action surrounding Eightco Holdings, we first have to establish what this company actually does on a day-to-day basis.
Right, because it's confusing.
It is. Because right now, its income statement and its balance sheet look like they belong to two completely unrelated companies.
Yeah, it's a severe corporate identity crisis. Operationally, Eightco has historically been just a conventional packaging business. They manufacture and distribute physical products.
Cardboard boxes, things like that.
Exactly. But recently, leadership has been executing this radical pivot toward an AI and cryptocurrency treasury strategy.
Which is wild. I mean, I want to break down the mechanics of a pivot like that. How does a company producing cardboard boxes or physical packaging suddenly become a digital asset treasury? Do they just shut off the machines and start buying servers?
Well, no, it's rarely a clean break. Usually management decides the legacy business just has limited growth potential, right?
Yeah.
So they begin redirecting existing capital or maybe taking on new debt or issuing new shares to acquire digital assets.
Okay.
They aim to integrate into decentralized ecosystems, maybe by offering infrastructure for blockchain networks.
Yeah.
But here is the friction. While they are building that new digital identity, the legacy physical business is still running. It still has payroll, it still has overhead, and in Eightco's case, it is bleeding cash.
Oh, massively. The income statement reflects that bleed perfectly. I mean, in the second quarter of 2025, they brought in just $7.6 million in revenue.
Which is not great.
No. And looking at the trailing 12 months, or TTM, revenue sits at $43.12 million. But the operational costs are just crushing them.
Yeah.
Their annual net income is a negative $32.22 million.
That's a huge loss.
Right. The TTM earnings per share is sitting between negative 2.42 and negative 3.02. And their operating cash flow is deep in the red at roughly negative 6.6 million.
Yeah, and if you approach those figures as a traditional value investor, like someone who evaluates a business purely based on the cash generated by its core operations, those numbers suggest an enterprise that is just on the brink of insolvency.
A sinking ship.
Exactly. The physical business is fundamentally failing to sustain itself.
But then we flip over to the balance sheet as of March 2026, and the picture completely shifts. It's crazy. Total assets are listed at over $325.9 million.
It's a staggering amount.
And their debt-to-equity ratio is just 3.1%, which means they have virtually no debt dragging them down.
Right.
And the centerpiece is this massive treasury holding. We're talking about $82 million in cash, roughly 280 million WorldCoin or WOLD tokens, and 11,000 Ethereum.
What's fascinating here is how this specific asset mix totally upends traditional valuation models.
How so?
Well, when you have a massive treasury of highly liquid digital assets, and you combine that with a microscopic debt load, the standard rules of bankruptcy risk simply do not apply.
Oh, I see.
Yeah, that 82 million in cash alone gives them what analysts call a stable cash runway of over 3 years at their current burn rate. So yeah, they might be losing money on the packaging side, but they have this giant financial war chest keeping the lights on.
So the mental model here is essentially a struggling, run-of-the-mill cardboard box manufacturing plant with old machinery and declining sales.
Yeah.
But management has converted the entire basement into a multi-million-dollar cryptocurrency vault holding digital gold.
That is the perfect analogy, and it creates absolute chaos for the market.
I bet.
Because investors hate ambiguity, right? The market struggles to price a company when it cannot decide if it is buying a failing industrial manufacturer or a proxy for a digital asset portfolio.
Right. And if there's a massive crypto vault in the basement, you'd think the market should theoretically be pricing in that underlying digital wealth.
You would think so.
Instead, the market has severely punished the stock. I mean, let's look at the damage on the charts because the fall from grace here is historic.
It really is. If we pull back and look at the 52-week range, the peak was an astronomical 83.12 per share.
$83.
Yeah, but the 52-week low plummeted all the way down to 74 cents.
Wait, 74 cents. That is a 99% drop? It's mathematically fascinating.
That's devastating.
Right. To go from $83 down to 74 cents means the market didn't just lose faith. It completely repriced the reality of the business.
Absolutely.
As of the close on April 15th, 2026, the price had recovered slightly to 1.12. That gives the entire company a tiny market cap hovering between 179.4 million and 225 million.
And this is really the foundation of the bear case. And it all comes down to how automated systems view the stock. Legacy algorithms and institutional screeners, they evaluate Eightco strictly through the lens of its legacy operations.
Right, the packaging stuff.
Right. They calculate valuation multiples like the price-to-book ratio based on industrial benchmarks.
Let's explain the mechanics of that ratio just so everyone's on the same page, because the sources highlight that Eightco's price-to-book ratio is 303 times relative to its packaging peers.
Yeah, so a price-to-book or PB ratio basically compares a company's current market valuation to its book value, which is essentially its total assets minus liabilities.
Okay.
For a standard packaging company, a PB ratio of 303 is absurdly high. It signals to trading algorithms that the stock is wildly overvalued for what the physical business produces.
So the algorithms see a declining packaging manufacturer with negative net income and this skyrocketing valuation multiple, and they just systematically execute sell orders.
Exactly. They are completely blind to the crypto pivot because digital assets do not fit neatly into that traditional industrial valuation code.
But wait, if these legacy algorithms are blindly selling off based on outdated PB ratios, isn't that like a widely known flaw in quantitative trading? Why haven't hedge funds corrected their models to spot this exact anomaly and stop the sell-off?
Well, because adjusting an algorithm to account for a massive, unproven strategic pivot introduces just way too much unquantifiable risk.
Ah, I see.
Algorithms are designed to measure current, verifiable operational efficiency against sector benchmarks. Asking a system to dynamically reevaluate an industrial stock as a crypto treasury creates a fundamental contradiction in the code.
Right.
Until the company officially reclassifies its sector, the machines will just keep seeing a failing packaging firm.
But while the algorithms are dumping shares, human insiders and massive institutions are aggressively buying. Which brings us to the most perplexing part of the data. Because if a stock drops 99%, you expect everyone to flee, like rats off a sinking ship.
Exactly.
Instead, in September 2025, the CEO and directors bought hundreds of thousands of shares when the price was hovering around 1.50.
And insider buying during a massive downtrend is a profound signal. It indicates that the leadership team, the people who actually see the internal metrics of the pivot, believe the market is fundamentally mispricing their transition.
Right.
But the institutional activity provides an even stronger validation.
Yeah, because in March 2026, a firm called Bitmine Immersion Technologies executed a massive buy of 87 million shares.
87 million.
Yeah. And it's not just them. The heavy hitters backing Eightco's AI and Worldcoin strategy include ARK Invest, Kraken, and Discovery Capital Management.
We have to look at why these specific institutions care. ARK Invest, for example, operates on a very specific thesis regarding digital identity. In a world increasingly populated by artificial intelligence, proving human identity online, what is called proof of personhood, becomes a critical infrastructure challenge.
Because you can't tell who's a bot and who's human.
Exactly. And WorldCoin is designed specifically to solve that problem. By accumulating Eightco's stock, these institutions are essentially acquiring exposure to that massive 280 million WorldCoin treasury at a really steep discount.
Okay, I have to challenge the optimism here, though. We have seen venture capital firms throw endless money at digital identity projects that go absolutely nowhere.
Oh, for sure.
A massive fund like ARK Invest can afford to lose a speculative bet. It's a tiny fraction of their portfolio. How do we know these specific institutions aren't just trapped in a sunk cost fallacy, hoping their sheer buying volume will spark a retail frenzy?
And that is the precise danger retail traders face. Institutional investors operate on a 10-year time horizon. They are buying the underlying structural potential of the AI ecosystem.
Are they going to wait?
Exactly. If Eightco burns through cash for another 2 years before figuring out how to monetize the WorldCoin, ARK Invest can simply wait it out. A retail investor mirroring that trade, putting a significant portion of their savings into a stock bleeding $32 million a year, carries a disproportionate and potentially devastating amount of risk.
Understanding the institutional mindset is really helpful, but it doesn't tell a day trader what is happening on the ground right now. We need to look at the immediate technical signals because the latest momentum is violent.
It is.
Let's break down the massive daily change on April 15. The stock spiked by positive 24.61% in a single day.
Yeah, the underlying order flow reveals exactly what happened there. We saw immense buying pressure materialize in the final hour of trading. That late-day surge pushed the stock aggressively from 95 cents right past the psychological $1 mark, all the way up to 1.14.
And the sources suggest this could be driven by a short squeeze. Let's explain the mechanics of a short squeeze for you listening, just so you understand the forces at play here.
Sure. Imagine you believe Eightco's physical business will continue to fail, so you bet against the stock.
Okay.
To do this, you borrow shares from a broker and sell them at the current price, hoping to buy them back later when the price drops further, pocketing the difference.
Right. Standard short selling.
But suddenly, on April 15th, the price ticks up. Your broker demands more cash to cover your losing bet. To protect yourself, you panic and buy shares to close your position.
So you're forced to buy.
Exactly. That forced buying from people betting against the stock drives the price up even higher, which triggers a chain reaction that forces more short sellers to buy. That mechanical feedback loop is a short squeeze.
And that sudden surge completely alters the technical map. Let's talk levels so you have a clear picture of where this asset is actually trading.
Yeah, the levels are key here.
The ultimate floor, the critical support level, is that 52-week low of 74 cents. If it drops below that, the whole technical thesis breaks down. But on the way up, this 24% spike pushed the price above a major resistance barrier, the 50-day moving average, which was sitting between 1.07 and 1.1.
And breaking above the 50-day moving average is a pivotal psychological victory for short-term traders. It basically signals that the immediate momentum has finally shifted from selling pressure to accumulation.
Wow.
However, the overhead supply is really dense. The next immediate resistance levels are 1.27, which aligns with the 20-day exponential moving average, and then 2.02 at the 100-day EMA.
And the ultimate ceiling, the massive overhead resistance, is the 200-day moving average sitting way up at 3.69 to 3.70.
Yeah, it's a long way up.
Getting past that requires a monumental fundamental shift in sentiment, which brings us to the ratings and the indicator signals, because they are deeply divided right now.
Oh, yeah. We are looking at a textbook technical conflict. Let's start with the AMUV, the moving average convergence divergence.
Okay, break that down for us.
This is a tool traders use to visualize changes in the strength and direction of a trend. It works by subtracting a longer-term moving average from a shorter-term one. When the short-term average crosses above the long-term one, the MACD flashes a momentum signal.
And what's it doing right now?
Right now, on the daily charts, the MACD is sitting between negative 0.07 and 0.03, and it is explicitly flashing a buy signal. The short-term energy is clearly pointing upward.
But then we look at the RSI, the Relative Strength Index. This measures the speed and magnitude of recent price changes on a scale from 0 to 100 to evaluate if a stock is overbought or oversold.
Right.
And the trading platforms cannot even agree on the calculation.
Yeah.
Some platforms show the RSI at a very neutral 44.26, but others, calculating immediately after that massive 24% spike on April 15th, show it heavily overbought at 74.38.
And when an RSI crosses that 70 threshold, it traditionally indicates the asset has been purchased too aggressively, too fast, and is due for an imminent pullback.
So it's a huge contradiction.
It is an intense paradox. The short-term technical oscillators, fueled by the squeeze, are signaling a strong buy. But the longer-term algorithmic averages, looking at the sheer weight of a 99% downtrend and the distant 200-day moving average, are signaling a definitive sell.
Which brings us to the core debate of this entire deep dive. With conflicting ratings, short-term strength colliding with long-term weakness, we have to determine the ultimate nature of this asset. Is this stock genuinely undervalued like a hidden digital treasure, or is it a classic retail value trap?
That's the million-dollar question.
Let's start by outlining the downside risks of the trap scenario.
The trap scenario relies on the fact that Eightco's stock price is no longer reacting to its physical operations, like at all. It is reacting almost entirely to volatile fluctuations in the broader cryptocurrency market, specifically the price action of Ethereum and Worldcoin.
Right, so a retail trader sees that 24% daily pop, experiences a rush of FOMO, the fear of missing out, and jumps into the trade. But they are completely ignoring the fundamental reality that the core business is still bleeding $6.6 million in operating cash flow.
And that's exactly the danger. If the broader cryptocurrency market decides to pull back, or if regulatory pressures hit digital assets, the value of Eightco's $82 million treasury plummets instantly.
Ouch.
Retail investors get caught holding the bag on a stock that fundamentally has not fixed its internal cash flow problem, while the external crypto tide just goes out.
Okay, let's argue the bull case, the absolute best-case recovery scenario. The long argument hinges entirely on successfully utilizing that massive treasury. They hold 280 million Worldcoin tokens.
Yeah, and the bulls argue that buying Eightco stock is simply a mechanism to acquire those digital assets at a steep discount compared to buying them directly on a crypto exchange.
Makes sense.
If management successfully executes the strategic pivot into the AI and digital identity ecosystem, and if they can integrate Worldcoin into a viable revenue-generating software platform, the legacy packaging business just becomes entirely irrelevant.
It's just noise at that point.
Right. And the heavy insider buying strongly implies that the leadership team believes this integration is already succeeding behind closed doors.
But the bear case, the worst case continuation lower, points straight back to the math of the decline. You cannot outrun a 99% historical drop without a monumental catalyst.
Exactly. If we connect this to the bigger picture, what we are really analyzing is a psychological battle. Investor sentiment is locked in a massive tug of war.
How so?
Well, on one side, you have crypto treasury FOMO. People see the massive Ethereum holdings, hear the AI buzzwords, and they just want exposure.
Right.
On the other side, you have fundamental fear. Traditional investors see the negative EPS, the deeply negative cash flow, and the sheer gravity of an asset that lost 99% of its value. The bears believe Eightco simply cannot monetize those crypto assets fast enough to stop the core physical business from bleeding out entirely.
It is such a fascinating concept. We are watching what I would call identity decoupling.
Oh, that's a good term for it.
What happens when a public company's ticker symbol becomes a derivative of a digital asset rather than its physical operations? The market is actively trying to price an industrial stock as a crypto ETF, and the friction is just tearing the chart apart.
It really is.
So let's break down the final outlook here. We need to clearly separate the timelines for you listening.
Yeah, in the short term, you must expect extreme volatility.
Yeah.
The day-to-day price action is going to be driven by technical squeezes, exactly like we saw with that 24% surge, and whatever the daily news cycle dictates for the broader crypto markets.
Right.
If Ethereum or Worldcoin experience a sudden swing in value, ORBS will likely swing violently with them.
And in the medium to long-term perspective.
It is the absolute definition of a high-risk, high-reward scenario. The final outcome is entirely dependent on whether their AI and digital identity ecosystem actually succeeds and generates real revenue.
The packaging stuff doesn't matter.
Exactly. The physical packaging business is the past. The digital treasury is the future. If they can successfully execute the pivot, the upside potential relative to their current tiny market cap is massive. If they fail to integrate, the fundamental downward pressure will resume and the stock will just continue to test that 74-cent floor.
So what does this all mean? We started by asking if this stock was a brilliant AI play or a massive value trap. The reality is that Eightco is a mirror, reflecting what kind of investor you fundamentally are. Do you trust the algorithms or do you trust the institutional accumulation?
That's really what it boils down to.
But I want to leave you with a cliffhanger, something to really chew on after you finish this deep dive.
Because it is a massive structural question this entire situation raises for the broader financial system.
Exactly. What happens to the traditional stock market when a public company's valuation completely detaches from the physical reality of its business? When a legacy corporation essentially abandoned its core operations to become a publicly traded proxy for a volatile digital token? If Eightco is the blueprint for this kind of transition, are we looking at the brilliant, inevitable future of corporate treasuries? Or are we just looking at a new, highly engineered mechanism for retail investors to get burned by crypto volatility wrapped up in a traditional stock ticker?
It's a scary thought.
It is, and that is something you will have to weigh for yourself as you watch this fascinating ticker. Thank you so much for joining us on this deep dive. We love unpacking these complex financial puzzles with you. As a final reminder, please hit that like button, subscribe to the channel, and drop a comment below. Let us know. Is this decoupling the future of the market, or is it a catastrophic trap? We will see you next time.